Welcome everyone to this session hosted by Carson International and Miller Thomson on customs verifications audits. What are you going to do when they come for you? With me is Dave Pentland. On to the next slide. And Dave, a little bit about yourself. You want to explain who you are?
Yeah, good morning or good afternoon, depending on where you are. Thanks, Dan. My name's Dave Pentland. I'm with Carson International. I'm the vice president. I look after regulatory issues, compliance issues. We're a medium-sized customs broker, freight forwarder, located in Vancouver, Toronto, Montreal. And pleased to join Dan today on a topic that's near and dear to myself. And certainly looking forward to Dan's sage words of wisdom. I'll turn it back to you, Dan.
Thanks, Dave, for those kind words. I'm a lawyer practicing at Miller Thomson, leading the global trade and customs group. We have offices across the country, and we focus on, amongst other things, customs audits, customs verifications, tax audits as well, and other bones of contention. Of course, I skipped over this, but this is not legal advice. This is just simply information. If you need legal advice, talk to a qualified customs broker or a consultant or lawyer to have your particular problems dealt with. So on to, without further ado, let's get to it. What's a customs verification? Well, we've seen a lot of them. And Dave's seen a lot of them. They're simply a process in Canada, they call it a verification, to verify, usually post-importation, whether or not the importer is doing things correctly. And every year there's a new crop of importers that are the subject of a verification. In the US, they refer to it as an audit. And there's different types of verifications, which we mention here. Multi-program, which is less usual, a single program, which is more usual, and that just focuses in on issues such as valuation, and a transaction line review. I haven't seen too many of those, but there are other types of verifications that can occur. They're less usual again, but they're really focused in on particular types of businesses. Say the duty relief program, you may have a system where you bring in goods under the exporter of processing systems. You have duty relief, and you're under this obligation, under a certificate, not to bring the goods into Canadian consumption. You're supposed to be exporting them. The customs officers may go in there and say, hey, we want to check on how you're doing that. Controlled goods, goods that are restricted in the way that they can be exported, and marking and labeling requirements. That's also a big issue, particularly in Quebec, where language and labeling and marking seems to be a big issue. So Dave, you've seen a lot of these types of issues, and they crop up from time to time in your view.
Yeah, definitely. It's I guess with the more and more importers and ease of importing products, there's more onus is put on after the fact. So what we're talking about today is certainly never on the release side of things. These are usually within customs follow-up, and customs can go back 4 years from date of import to verify your declaration. And like Dan said, these are the various components. It's becoming a bigger issue, and a lot of it's driven these days, people aren't aware, by Statistics Canada actually will focus and give CBSA their marching orders to take a look at garments, to take a look at footwear, take a look at controlled goods, etc. So
the biggest takeaway, folks, that I would want to leave you before we get into the thicket of it is make sure you treat a verification with a sense of urgency. From time to time, we get involved kind of halfway through the process when somebody gets an interim verification report and the CBSA has already kind of formed a conclusion as to how things should be and whether or not there's a problem. And sometimes it's difficult to move the CBSA off of that position. Right at the get-go, make sure you treat the thing as with a sense of urgency. You get the resources. Maybe it's from the C-suite. Maybe it's from, you know, the tax department or the customs manager, and assign a point person to handle this thing, and make sure that all communications go through that person. And don't have a casual approach to this. You know, seek resources. If there's complex problems, get a customs broker or get a consultant or a lawyer to help you stick handle through this. The process can be, you know, unnerving. It can be difficult. It can be time consuming and complex. And if you have the right advice, that can change in a minute. You can have a little sense of relief that your issues are being handled appropriately in the best possible way, because we've seen these things. We've seen this movie many, many times before.
Yeah,
On to the next.
yeah, Dan, I'm just going to further comment without stalling your presentation. Is
No,
that
no.
that's really, really important. We have seen a lot of instances where our importers or other people have actually reached out and tried to sort things out or start the verification with customs directly, both in Canada and the United States. And I kind of look at it, it's like standing up and deciding to defend yourself in court by yourself. Yeah, you know, the path has already started, and it's better to, you know, first and foremost, reach out to your broker. And certainly if we need some heavy lifting, we rely on Dan's team. If we believe that there's a couple extra zeros in there, or if it seems like customs is headed down a path that seems to be very punitive, you know, I can't stress enough that you need to reach out. Don't deal with, because sometimes we've got involved down the road, and like Dan's mentioning, customs is already determined that something's happened, or you may have got somebody within the company that's reached out that shouldn't have, and given information that you should have protected it. So.
Yeah, and when these verifications start, they start usually for a reason. There are verification priorities that are listed every January and July, and the government picks what they think are the low-hanging fruit, and they go after particular industries accordingly. And so it may be apparel this year, it may be, you know, fresh cut flowers the next year, it may be, I don't know, upholstered seating the next year. They pick these things for a reason. So you, when you get this letter, you have to treat it seriously and you know, carefully. How do you deal with this? Oh, and it also covers usually a calendar year. So they'll pick a verification year. If this happens this year, say, they'll be looking at the 2020 year. And as Dave mentioned, they can go back 4 years. In Canada. In the US, it's 5, I believe. Companies with strong internal controls that have an idea of what they're doing with their customs processes are going to be better bets to win a customs audit, to successfully complete a customs audit or customs verification. So the best way to deal with an audit is to be ready for one, ready to welcome an audit, as Dave might put it, before an audit happens. So have, if you're dealing with, for example, valuation, have a worksheet, have an idea how you're valuing goods, how you've instructed your customs broker how to value them, and what is the thinking behind it. And same with origin, classification, GST, and all the other programs. On to the next slide. Key areas to prepare for: systems and methodologies for accounting for duties and taxes. I've mentioned the spreadsheet. The CBSA has put out a handy dandy spreadsheet for all the different methods of valuation, the primary method being the transaction value, and you can make the adjustments that are set out within the relevant provision, section 48. You add certain things in and you deduct certain things out, and you can come to a particular result as to how you value your particular goods for customs purposes. Controls to track information underlying customs declaration. I mentioned, for example, duty relief programs. You might want to know whether or not any of your goods have been, you know, diverted into the Canadian consumption. Where needed, procedures in place to monitor corrections. For example, we've had experience with large mining companies. They've brought in goods, they're provisionally valued. The correct value is expressed when you connect up at the end of the month with the London metal exchange value for a particular commodity, and then there has to be a correction, and sometimes that gets forgotten. Where needed, procedures in place to monitor compliance with specific customs programs, and it's almost self-evident that you should periodically but regularly check and make sure that the things that are supposed to happen on a regular basis. We had experience with a duty-free shop once where goods were received and then they went out to the consumer before they receive customs release, and that's a big no-no, and that can cause all sorts of problems. CBSA was not they didn't see the humor in that. On to the next slide. Assign adequate resources and time for the verification. I'm a true believer in having one person responsible within the company for handling the verification or the audit, and then if there are requests for information, getting a team of people that can help to get the documents in order. Maybe there's going to be a verification visit. There might be other odds and ends that have to be put together. There may be samples and stuff like that have to be done. Get that team put together. Understand the consequences of like the financial exposure. If you have repeated importations and the issue is, for example, valuation, even if the value is small, the financial exposure, the risk could be large if you have a potential of going back 4 years. So provide prompt, succinct responses to queries and documentations. I always describe this as acting like a duck, being calm on the surface and paddling hell underneath. Dave, any comments on that one?
Yeah, I just want to point out that normally when you get requested for a review, if it's going to be a review, sometimes customs will lead you down the rabbit hole that they'll pick 10 entries, and it looks as if you're responding to requests just on those 10 entries. And when you're talking about financial exposure, they can and will go back in time if it's found that those 10 entries, there's the same issue going back. Now, normally they won't go back 4 years, but they will go back 2 years. If they believe that you have known about these errors and you have not corrected them, they can go back 4 years. So it's something that, a lot of people just go, well, they're asking about 10 entries. I'll just get my broker and we'll fix those 10 entries. The consequences are they can go back in time. So they kind of lead you into, well, let's just answer these, and they appear very nice, but really once they determine those, they will go back in time. So.
I mean, the verification could be done very friendly, but the consequences might be very unfriendly. If the officer says, okay, we've discovered a problem with those 10 entries, and we'd like you to correct for all the similar goods going back.
Right.
And then they got you.
And I should point out, even if it's a non-monetary issue, they can force you, and we've had to do it as a broker, where we've had to do amendments for our clients, which seems ridiculous, but they usually put the onus that Statistics Canada needs to know that these are classified properly. And in this instance, there's not a duty issue, but we still want you to make corrections. And so sometimes this becomes a big issue because there is a cost associated with amending entries going back in time.
Okay, on to the next one. We talked about this, assigning a lead spokesperson. It's just an information flow, information management issue. I've seen situations where there's multiple people giving multiple answers, nobody has any idea what's going on anymore. And so you don't know what the government's got, they don't know what responses they have, and it's a mishmash, and it leads to finger pointing and tears. Don't do that. Have one person. That person should be made aware of the scope of the verification. They should have that verification letter, the letter that goes out to the importer. It says out what is the issue, right? That's the scope. And if their government is going on a fishing expedition, they want to go somewhere else into the ether, don't let them go. It has to be confined by the verification letter. That's the scope. If the government wants to expand the scope, fair enough, but stay within the program. Any representative hired by the broker should know the theory of the case. What is the case? Say it's valuation again. We go there quite a bit because that's one of the biggest issues. Are you valuing the goods on the primary method? Are you a purchaser in Canada? Do you meet the rules for valuing on the basis of the supply cost rather than the customer cost? What's your theory of the case? I go there because that's my go-to as a litigation lawyer, dealing with conflicts and disputes and how they are resolved. So you've got to know going in, what is it that you are going to try to prove to the CBSA if it's a valuation issue or an origin issue or a GST issue. Next slide. Currently, the most common verification issues are valuation. Origins also getting to be important because of the USMCA and the changes in the rules of origin. We also have other agreements such as the Comprehensive and Progressive Trans-Pacific Partnership and the CITT agreement, the European agreement. So the officers are, for valuation, often wanting to focus on, what is the transaction value method? That's the primary method. It's the price paid or payable. But which price paid or payable are we looking at? Are we looking at the price that the importer paid the supplier? Or are we looking at the price that the customer paid the importer? Because they're going to be two vastly different prices. There's going to be a markup. And if you can use the supply cost rather than the customer cost, you're way better off, because the value for duty is ad valorem. It's according to the duty is applied at a rate according to the value of the goods. So that seems to be the biggest issue, and non-resident importers seem to be the ones that are caught most by valuation audits or verifications these days. So know before you go, I think, is the phrase I want to leave you with. Before you start up, if you are starting up, get advice, know how you're going to do your valuation, and know how you're going to justify it going forward. And the same applies for origin. Do these goods, meet preferential tariff treatment eligibility criteria? What are they? How do you show them? Do you need a certificate, or do you need a statement? What are the things that you're going to need if a verification officer comes and gives you a questionnaire? Dave?
Yeah, I would just say that this is very topical, and it's driven by the World Customs Organization, because multinational and multi-country brands are looking not only to lower values within countries, and in some cases now, and it runs the irks of customs because they have a hard time understanding it, of increasing the prices within countries because they like to maximize shareholders' return by creating the most amount of revenue in lower tax countries. So it's very topical, like Dan's saying, and it's something I anticipate seeing more and more of it going forward. So.
Next slide, please. Yeah, so we're getting in a little bit into the transaction value method. There has to be a sale for export to a purchaser in Canada, and the price paid or payable can be determined. Normally, the price is not the issue. It's just which price can be applied and whether the goods have been sold for export to a purchaser in Canada. And in some circumstances, a non-resident, for example, can be a purchaser in Canada. And we've talked about this before. A non-resident is for import purposes, is a company or business that does not have mind or management in Canada. So it may be a BC company with non-resident directors. That can be a non-resident importer for customs purposes. In such circumstances, in order to have a sale for export to a purchaser in Canada, you have to have a sale from a supplier to, for example, the non-resident, if that non-resident has a permanent establishment, or if that non-resident imports the goods as unsold inventory. So there's tricky rules that you need to know of before you get into a big business of importing high volume goods because it's volumetrics. The liability or the risk increases according to the volume of the goods that are imported. On to the next slide. So the big, for valuation, the big provisions that you need to be aware of in planning are sections 2 and 2.1 of the valuation for duty regulations. And as explained, a non-resident, for example, can be a purchaser in Canada if it has a permanent establishment or it imports goods on speculation and sale as unsold inventory. On to the next slide. So to apply the price paid or payable, it is not necessarily the case that you have to have a set figure right in mind at the time of importation. It means that you can determine the value according to a formula. And I think there's a case called Toyota that deals with this particular matter. And I alluded to this earlier. You may have a situation where you provisionally value and then have to true it up at the end of the month or whatever, according to another commodity exchange price that the value is linked to. Those types of cases happen from time to time, but they're rather rare. Just have a system for dealing with these things and knowing what you're doing before you do it. On to the next slide. Tariff classification, big issue again, Dave. We deal with that often in the area of supply management. And you've seen these types of cases, eh?
Yes. Yeah. I mean, the big issue is you may have a primary broker you're dealing with who has a tariff database that's linked up to the SKUs in your products. And however, there are instances where people bring in samples or smaller lots using an express courier who may not always rate things correctly because they're dealing with volumes coming in at night. And this is kind of low hanging fruit where customs can actually go in and pick on those. And then it's up to the importer to explain why one broker is classifying it correctly one way and why another broker is not, because you as the importer are liable for the work that's being done by the broker. So.
Yeah, so we've dealt with several of these types of supply management imports. You know, one was buttermilk, I think it was, for yogurt. And the result of it was an assessment of $45 million worth of duty based upon 300% duty. And it was an incorrect classification, and the movement into the dairy classification resulted in the assessment of 300% duty approximately, based upon the fact that there was no permit. Same thing for another case involving ice treats from Korea. It was classified as an ice treat, and it was reclassified as a dairy product. And again, $15 million worth of duty all of a sudden. Chicken corn dogs, same deal, $15 million worth of duty. Then, the question is, can you move it out by, for example, applying for a retroactive permit? And that's to fix a problem after the fact is 10 times more difficult than doing it correctly at the beginning. Applying for the permit, properly classifying the item, and getting it done so that you don't have a headache later on is probably the best way to go. There are rules for interpretation of the classification rules. I won't bore you with the details, but just be aware that you have to stick with the rules of the game, and those rules kind of guide you as to how to interpret the classification system. And folks like David probably can tell you how to classify the pen in your hand that you're holding right now. So use the resources that are available to you. Yeah,
and I'd just like to comment that in the news, you often hear the United States does not like Canada's marketing boards. And so our marketing boards are responsible for the tariff rate quotas on most of the agricultural goods. So unless you're in the trade or dealing in this, most people don't, when you shop, you realize that chicken, turkey, milk, cheese is much, much cheaper in the United States because those marketing boards control the tariff quotas, or through our government. The government controls tariff quotas, and those are meant to help our industries support themselves in Canada, which artificially keep those prices, I'm going to say, somewhat above where the market level is. So if you want to import cheese, and if you call my office, we'll tell you that unless you have quota, you can't bring cheese in, because what Dan is talking about, if you bring cheese and you have quota, it might be 0. If you don't have quota, it could be 300%. So you don't want to go down that rabbit hole, because that's usually when we give Dan a call, because we get pulled in that somebody's been doing this. And now you have to see if you can get retroactive quota, which sometimes is very, very difficult. So.
Yeah, what we usually see is folks that incorrectly classify, and then they get verified, and then the classification is not what they want, and that's not a good thing. Okay, so on to the next slide. Trade agreements, origin. That seems to be a bigger and bigger issue these days, given that there is a multiplicity of different free trade agreements, and they all have different rules of origin, different ways of proving origin, and different ways of getting things done. So it's again, if you're going to ask claim preferential tariff treatment, say duty-free treatment under the USMCA or the CUSMA or the TMEC, whichever country you're from, how you describe it, then make sure you know the rules of origin, and don't assume, for example, the old NAFTA rules are going to apply to the new USMCA CUSMA, because they might not, and old rulings might not apply. Good thing to go through and do your self-assessment before you start making preferential tariff claims. David, any comments?
Yeah, I mean, my big comment always to people is do your homework, because, and certainly when you're dealing with either the United States or even foreign countries, under the CPTPP, I'm going to just pick on Vietnam. You may have people saying that the goods qualify, but it's up to you to do a little bit of homework, because the penalties are never incurred by the exporter. The penalties are levied against the importer. So it's not even a level playing field, because quite often you may have purchasing people within your company saying, well, I'd like to buy goods from your country, but I need them to qualify under your. Do they qualify? And unless they've done a bit of a dive on how goods qualify under the specific rules of origin of that agreement, they may just say yes and give you a certification. But again, if somebody takes a look and the goods do not qualify, all the penalties are on the importer. And so do your homework.
Next slide, please. What happens if you fail? Well, it's not a good scene, really. You have an obligation to make corrections. David alluded to this. There is a policy that can limit the correction period, the adjustment period, they call it in the policy, to 2 years, basically, the verification period going forward. But under the law, you could be obliged to correct going back 4 years in Canada. And similarly in the US, there's a period which you may be required to correct. And that could lead to significant costs, not only in terms of the actual assessment of duties, but in terms of doing the work. Like this, it could be like a giant job, and that's not a lot of fun to do. So there may be also administrative monetary penalties, depending upon whether or not this has happened before or whether or not it's deemed to be deliberate. There may be administrative monetary penalties. There may be seizure and forfeiture of goods. We've had a few situations where goods were just simply not reported, and they were released into consumption without having the goods reported. And that is, if they come in illegally like that, it's subject to seizure and forfeiture, not just an administrative monetary penalty. And then subsequently, you're on the hot indicator list. You're in the red zone in terms of a importer business, and delays, problems at the border. If you've had a shipment that's being flagged before, chances are it's going to happen again. The same at the same port, especially the officers are going to keep an eye on things for you. And that is, those are the significant consequences of failing an audit. Corrections also have to be made within 90 days. So if they spot a problem, as we mentioned, they may say, we've got those 10 entries that we did samples for. We'd like you to go and correct everything else that looks similar. And if you don't do that, it's not good either. It's not, you don't want to do that. Dave, any comments?
Just one that, we've got involved where some trade consultants have gone in and decided to go after an HS code, which may have been accepted by the first round of customs officers looking at it, and covered, and then customs looks at it and appeals, and then makes a verification that it's not allowed. You have to go back and correct those as well. So it's, I mean, in the 90 days sounds like a long time, but when you're involved in thousands of transactions, it can be a real push on both importers and brokers to comply within the 90 days. So just.
Yeah, sometimes you can get an extension, but it's rarely granted these days, I think. I don't know. I haven't asked for or received an extension of time for doing this for a long time. On to the next slide. Yeah, we mentioned this before. Doing a self-review is a good way to mitigate your risk. And we've done this before, say, for example, for a company that has an office in Calgary, an office in Houston, they're importing and exporting petroleum products. They want to know, are they classifying the goods properly? And are they properly claiming NAFTA when they should be? And and are they valuing the thing properly? And so you can do a self-review. It's similar to what an officer would do. You do maybe a sample of transactions in various business units and see, do a spot check as to whether or not you're doing it correctly. And if you find an issue, go ahead and correct it. And if you see a duty consequence, there is a policy in the CBSA somewhere that is of the effect that if you spot it on your own, you may be able to just make the adjustment going forward and not have to make the corrections going back. But that you need to noodle that through and make sure that that's applicable to your circumstances. You can also use a voluntary disclosure program in certain circumstances and avoid any penalty, and then just account for the duty, or just do an ordinary correction, I suppose, and see if you can do it that way. David?
Yeah, I think it's worth pointing out, if you do this kind of self-review and you find yourself on the end of a customs audit, point out to customs that you have and offer to show them that you actually have a system in place. A lot of times you'll find that instead of doing an on-site customs audit, it'll become a desk review because they believe that you've got a system in place and you're looking at it, and these might be very minor issues. So if you do that internally, and certainly a lot of the larger companies do, because they've been subject to audits in the past, point it out to customs, brag about it a little bit to them, that this is something that you just are not undertaking because customs has come calling. You actually do this on an ongoing basis. So be proud of it and advertise a little bit.
Yeah. Conversely, if you've got like a problem and there's a problem, it's often useful to get a hold of a lawyer because you can keep information confidential and you can figure out what's your strategy going forward without having to disclose the information to the government if they come knocking on their door to deal with your strategy. So different ways of approaching different issues. Next slide, please. Different types of documentation is required. You have to be attentive to the process, and timeliness, I can't stress this enough, is important, because as soon as the government sees that there's delays and you can't get your tackle in order, they go, what are we dealing with here, right? Are we dealing with somebody that actually has a good system in place, or are we dealing with something less than that? And it's a secondary indicator of reliability, if you want to put it that way. If you can't get your homework done in 30 days when they ask it, then there's questions about that. And you can ask for an extension of time, and it's often granted. But the better course of action often is to get your homework in, at least get a response back in a timely way, and then say, we've got whatever the reason is, we've had a change in management, or there's a loss in corporate knowledge, or whatever, we need a little extra time, or we need to assign some work to Dave at Carson to help us out, or whatever it is.
Yeah, I would say that the sooner you can ask for an extension, the better it is, and give the reasons to CBSA. They truly believe that if you wait until on the 88th or 89th day, you have to apply for an extension, it's just either your books and records aren't in place or you haven't put the time and energy into it. So I always tell people early on, if this is looks like because of the volume of information that's required, or if there's issues going on, we've had clients saying, well, this is hitting us right at year end, or certainly when COVID started and people work from home, some of our clients were using that. Stress to customers at that point, this is why you're applying and this is the reason for it, and do it early on. And those extensions are usually granted because they look pretty callous if you've given reasons why you need the extension and they're cutting back on it. And I think in their little playbook on how auditors are supposed to respond, I think they have something in there. I haven't seen it, but makes them suspicious if you wait till the 9th, the deadline almost, and then you're asking for an extension. So that would be my big takeaway.
Good point. Next slide, please. Scenarios. Okay, we've had a few scenarios, right, David?
Yes, yeah. These get interesting. So
let's go to scenario number 1. Instant Noodles, the mysterious case of Mr. Noodles. Well, this was a verification that happened. We weren't on as counsel right away, but the CBSA had a ruling, and the ruling said that the goods should be classified in a particular way, and they decided we don't like that ruling. We're going to assess the importer after a verification. They're doing it wrong. So there was a 2% increase in the customs rate, and we had to go back to CBSA and say, you can't do it. It would have been illegal for the importer to actually classify it in the new way because they had a ruling that told them they had to classify it in the old way, the lower duty way. And this is one of the first times I've had this happen, but they canceled the DAS. They canceled the assessment before it went to the redress. However, because somebody in CBSA was directing traffic, they said, going forward, we want you to classify it in the new way. So there's quite a bit of money at stake, and we appealed that particular decision under Section 60 of the Customs Tariff. On to the next slide. So CBSA agreed, the appeal division recourse agreed with the verification officer that the instant noodle products should be classified not as a noodle, but as a soup, because it was 6% duty instead of 4% duty. I don't know if it was because of that, but that was the outcome. It was 2% more. And because you're importing like 1 billion of these things, there's a lot of duty at stake. So then we appealed the matter to the Canadian International Trade Tribunal, where all these appeals go under Section 67 of the Customs Act. And the discussion point that I think Satinder put in there, or Dave maybe, is should the subject good be classified as a pasta, as a noodle, and those, everybody's seen them, or probably eaten them at some point in their life. Are they soup preparations or are they pasta? And there was 2 different subheadings involved, 1902.30 and 2104.10. That was the weighty issue before the tribunal. On to the next slide. Well, the tribunal, surprisingly enough, determined that the goods were a preparation or mixture, blending ingredients, and a combination of materials. And ultimately, the goods would be considered a pasta because that was a combination of materials, and predominantly it's pasta. And we go back to the original ruling, which was favorable to our client, and it was the lower value. And so we get money back.
Yeah, I think, Dan, it's worth pointing out that the CITT is the governing body that if we lose all our appeal processes or on the way through customs, the CITT is an independent group that looks at it beyond, and they don't report to CBSA. So they're on top of it, and their decision, if CBSA doesn't like that, they can appeal further in the courts. But CITT, probably 50% of the time, rules on behalf of the petitioner against CBSA. So it's sort of half of the time, and so it's sort of your court where you can go to. And we should probably even do a section on how do you represent yourself at CITT, because it's pretty interesting, and it means that if you've exhausted everything with CBSA and they don't like what you're telling them, and you believe that you have a case, you can go to the CITT. So
Yeah, just to, it's a very good point. In this case, there was a ruling, the importer got a ruling, then there was the verification, the officer did the verification, they did it wrong, and then we had it canceled, but then they decided going forward, this is the way it's going to go. And then there is an, administrative level of appeal, and then there's the CITT level on top of that. So that's kind of like where you go with all these customs cases. On to the next slide. Footwear, Canadian liability, limited liability distributor. They're usually a subsidiary of an American parent or some foreign parent that has limited liability. They're basically receiving goods, and they've already, they've gotten sales, so they have a limited liability. The CBSA conducted a verification. The findings indicated that the limited liability distributor would not be considered a purchaser in Canada. It did not meet the valuation for duty regulations of having a permanent establishment. And a permanent establishment is a technical term. It means a fixed place of business through which you are carrying on business through one or more employees or dependent agents at that place of business. So you've got to have all those ducks in a row if you want to be a purchaser in Canada and you're non-resident. On to the next slide. So it was appealed, the matter was appealed on the basis that the limited liability distributor had a warehouse, Canadian employees, Canadian bank account, Canadian liabilities, and Canadian revenue, and its staff carried on business through the warehouse as well as an adjoining showroom. The officer was reluctant to determine that the limited liability distributor was a purchaser in Canada on the basis that it had a permanent establishment, and a compromise was reached. What was the compromise? Well, in this case, it was determined that the deductive method would be used as the basis for the value for duty rather than the transaction price. And the net result of it was that it was entitled to use the supply cost basis. There are some technical references in here under the deductive method. The CBSA's method for establishing the value for duty did not allow for markup amounts to be deducted. Under the Act, it says that you use, I think it's a unit value, and you're allowed to deduct out profit and general expenses. But the government said, no. Reason why? The company wasn't making money. It was in a loss position. We disputed that, and we said, yes, you can. It doesn't matter if ultimately at the end of the year, the company was in a loss position, because that has to do with their expenses. What we're doing in this case in determining the deductive value, their correct value for duty, is determining what is the price per unit and deducting out profit and general expenses. And that's what the provision provides for, regardless of whether at the end of the day, the company was making money or not making money. So ultimately, the government agreed with that, and we were able to use the lower supply cost method. Happy ending. And to the next. FTZ, foreign trade zone. Some folks may be very familiar with this. This is a place in the US usually where you can store goods duty-free. Our Canadian equivalent is kind of the customs bonded warehouse. situation. And so we had a case where, folks had a ruling, and this company had a ruling. It was a global company, and the CBSA didn't like the ruling anymore, and they wanted to change it. So the goods were shipped to the parent company's warehouse, US Co, for storage and distribution. The warehouse was located in a foreign trade zone in California, and the goods were shipped to Canada on an as-needed basis into Canada for Canadian sales orders. The goods were not stored longer than 6 months at the FTZ warehouse before being shipped, and CanCo sought approval from the CBSA in the rare case that certain goods had to be diverted into the US market. So they said, well, look, sometimes we don't want to sell them into Canada. We want to sell them into the US. The CanCo had obtained a ruling that the goods are considered to be direct shipped to Canada on the basis of the transshipment rules. And the purchase price between CanCo and the foreign vendor served as the basis for the value for duty. So they were able to use a lower value for duty, and the goods would be considered directly shipped to Canada, even though they stopped at the FTZ. And L was fine, well, and good. On to the next slide. Well, the CBSA does a verification and a review, and it overturns its own ruling, and it says that the goods are being inventoried at the FTZ, and they can't be considered direct shipped. The sale for export to appraise the value for duties into Canada would be based upon the selling price between CanCo and the Canadian customer, which is bad because that's going to be the higher value. It's not going to be the supply price. And the CBSA considered the sale between the Canadian company and the Canadian customer to be the basis for the value for duty. So the discussion point here was, should the goods be appraised on the Asian vendor's selling price or CanCo's selling price to the Canadian customer, the customer price or the supply price? And recognizing that the supply of goods comes from Asia to an FTZ into the US and then goes into Canada. And the goods were not longer than 60 days, but the company wanted to divert some of the goods into the US. On to the next slide. Well, there's some direct shipping regulations. They say that where goods are exported to Canada from a country but pass in transit through another country, which we said was an FTZ in the US, the goods shall be deemed to be direct shipped to Canada from the first mentioned country, in this case, Asia or China, on the condition of the journey of the goods is uninterrupted and the import of the good complies with Section 3. So that's the basis for our position, which was that there was a direct shipment and the goods should be considered direct shipped, passing in transit through the FTZ. And then Section 54, which is there, it says, for the purposes of valuation, basically where the goods are exported from to Canada from any country but pass in transit through another country, the goods shall be deemed to be shipped directly to Canada. So we get to use the valuation rules that we want to. Those are the key provisions that we pointed to. On to the next slide. And then the customs tariff says direct shipments for the purposes of the act, the goods are shipped directly when the goods are conveyed to Canada from another from that other country on a through bill of lading to a consignee. And so here the goods were purchased by CanCo. They met the requirements for transshipment, which were set out in the customs tariff. And after some lengthy discussions, the verification officer allowed for the use of the FTZ so that the goods could be bought in China, brought into the California FTZ, and then shipped into Canada and considered transshipped, and a more favorable valuation could be ascribed to the goods. It was a positive result again. On to the next slide. Non-resident importer imported some transformers from Korea to Canada, The importer was unaware that there were Special Import Measures Act provisions and countervailing and anti-dumping duty rates of 100%, 101% were applicable to these transformers, and they're high value goods. So, the duties were in excess of $1 million. The importer asked us, okay, what do we do? Is there a way to get most of the duty refunded? And so we considered, is there a method to get the CBSA to reevaluate the SEMA duties? On to the next slide. The importer in this situation couldn't appeal the declaration as there was no Section 59 assessment. Usually goods are brought in under Section 58. They're originally declared, and then a verification officer under Section 59 makes a further redetermination of the value for duty and assesses them. In this situation, it was just a levy on the basis of there's an order under the Canadian International Trade Tribunal that certain goods are subject to this particular SEMA rate. And so we didn't have Section 59 to appeal to under Section 60. So there was a technical problem, but we found a way out of it. We assisted the client by preparing a remission order. And remission is basically a request to the government that the assessment be waived on the basis of a discretionary relief provision under Section 115 of the Customs Tariff. And so the importer informed the vendor, Korean vendor, of the difficulties and requested that the vendor obtain what's known as normal values, which would reduce the SEMA rate. So they said, well, go get these normal values. You didn't participate in the program before, and that's why we have these high values. If you fill out the questionnaire, you can show that the goods haven't been subsidized. There's no unfair trade practice. We can get proper normal values, and we won't get hit with this crazy 100% duty. The importer couldn't appeal, and an appeal would need to establish that the SEMA rate was not applicable. But we prepared a remission order and we said it's unfair. On to the next slide. A CBSA officer was assigned to it, and after about a year, the vendor came up with these normal values showing that there was no subsidy and that the goods were not being dumped under the lower than their cost. And we informed the CBSA officer that was processing the remission request, and we were able at the end to get part of the duty amount that was paid back as a remission under a remission order. So the government agreed, okay, the normal value should be set at a more appropriate level. There was, in this case, no subsidy or unfair trade practice. It was caused as a result of a mistake. The supplier didn't participate in the request for information process. We will give you basically a refund. And so that was outside of the normal appeal process. So in some situations, you have to think outside the box and consider other appeal mechanisms outside of the normal administrative appeal or CITT appeal mechanisms. So those are three sample areas, which or four, that show you the kinds of cases that we've come across and how we've dealt with them, and what kinds of things you may have to think about if you get caught up with a CBSA investigation or verification into, for example, valuation. On to the next slide. Well, and that's all I have to say about that. David, over to you.
Yeah, I'm just going to say one comment on the anti-dump. Anti-dump in this day and age when everything is available online, I have to caution people that quite often people will call us and say, I took a look online, and I'm just going to pick on one that's current as of May 5th. Upholstered furniture from China, it should be coming in at 10% duty. And so I want to pay 10%. They reach out to their party in China and negotiate a price. Well, that's just part of it. Behind the scenes, and not always readily available, is anti-dump has their own provisions. So you may get a tariff rate. However, as of May 5th of this year, both out of China and Vietnam, there's punitive duty rates to run up to 300%. So you may be budgeting to bring in those products, and unbeknownst to you that you looked up the tariff code, and there's actually a SEMA provision that's got anti-dump. And anti-dump is one of those areas that, you know, Dan, we should probably do a whole section just on anti-dump, because they're very punitive and people don't understand how the workings work, but they're very restrictive, and they're very punitive, and they can, unless your vendor helps provide information to our government, you can be lumped in with a group that didn't respond, and you get the general rate, and the general rate's very, very high. So I just guess a word of caution. And the other comment from everything today is that often we get pulled in where CBSA has had a win under some type of verification, and maybe that win just has not been appealed, and they use that as a benchmark to go forward and go after other people in the same industry. And quite often it just means that you need to seek outside resources, and certainly our firm uses Dan and his team when we need some heavy lifting, and customs needs somebody with an LLP after the name to realize that our importers are very serious about protesting this, and it's worth appealing. It's worth looking at. Don't just go with what CBSA has told you on the first pass. So I think that's my comments for the day, and I'll turn it back to Dan to sort of wrap things up. But thanks again, Dan, for you and Miller Thomson co-hosting this with Carson.
Thanks, David. Thanks for the kind words. So that brings us to the end. I hope you found this to be informative. We look forward to providing you with another session, another hot topic in the near future. And with that, I want to wish you all a great day, and stay safe. Bye for now.
Bye now.